Hello, I'm James Yardley. I'm the Senior Research Analyst at FundCalibre. I'm joined today by Ben Leyland, the Fund Manager for JOHCM Global Opportunities. Thanks for joining us, Ben.
Thanks for having me.
Ben, one of the key differentiators of your fund is you really focus on capital preservation. Can you explain to our viewers what that means and how you go about it?
We take our role very seriously in terms of managing our clients' capital, both through the good times and also through the maybe more volatile periods in the stock market. We're also of the view that we don't know how to forecast which direction the market's going over the next 3 or 6 months, say, even in that kind of short-term time horizon. And therefore we need to act at all times in a way which will allow us to participate if markets go up, but protect capital if markets fall. And I think related to this is the concept of risk. And our industry is dominated by the idea that risk is to do with short-term performance relative to a benchmark, whereas we think the biggest risk to clients' capital is the permanent impairment of that capital as a result of taking inappropriate risks at the wrong point in the investment cycle.
And is that one of the reasons why you're happy to hold a very high weight in cash in your funds when you think valuations are expensive?
Yes, it's related. We think there are 3 particular characteristics which destroy capital if you invest in companies with those characteristics. Point 1 is weak franchises, which won't last the test of time, maybe are structurally challenged or technologically challenged. The second is companies with too much debt. And the third is overvalued assets. The big lesson of the technology bubble in 1999, for example, overvalued prices. And so when we see opportunities to invest our capital, we will. But when we struggle to find enough ideas to fill the portfolio, either because there's too much debt in the world or because shares are overvalued collectively, then we will hold some cash in the fund waiting for better opportunities to come down later down the line.
And what kind of catalyst would cause you to put some of the cash you've got to work?
We either need to see assets that we like but are too expensive get cheaper, but that will be on an individual stock basis rather than necessarily the whole market falling. Or we need to see companies that we perceive to have too much debt pay off some of that debt and fix the balance sheets in order to make themselves investable again.
And I think all your holdings are in developed markets like the UK, Europe, US, Japan. Do you not like emerging markets? Do you not see opportunities there?
One of our big focuses is on the economic exposure of the fund rather than where things are listed. So the fact that, say, Unilever is listed in London has nothing to do with where the economic exposure of Unilever is, which is predominantly emerging markets as well as a lot of Europe and America. So when we think about the risks we're taking on in our portfolio, we think about that side of the equation rather than where things are listed. And we do have emerging market economic exposure, but we hold that through owning multinationals listed generally in Western markets, because that gives us a degree of protection and diversification, which comes in handy when volatile times hit the equity market.
And Ben, I think investing in quality is an important part of your process. Can you explain to us what that means for you?
Yeah, that's a good question, because we think it's one of the things that differentiates us from many other funds with a quality bias. We define quality quite broadly, in the sense that while we like companies with predictable revenue streams like software businesses or recurring repeat consumption consumer staples businesses, we also see quality characteristics in certain more cyclical or capital intensive areas of the market. What we're looking for is a business that we're confident will last the test of time, that will be around in 1, 2, 3 business cycles. And not only do we find that in, say, L'Oreal or Sage and Microsoft, we find it in, say, the US rail industry, which is cyclical but very high quality in terms of barriers to entry, or regulated utilities, which have great, huge barriers to entry around their networks of pipes and wires, although they're more capital intensive to build.
And in a recent update, you mentioned that stock markets are currently dominated by investors' fear of missing out. What does that mean?
It means that a lot of fund managers are very focused on how to outperform rising markets. And we've been in an environment so long that the biggest career risks to a manager seems to be the idea of lagging a rising market and not owning, say, Facebook because it's what's leading a rising market. We think that's back to the idea of only managing equities for a part of the cycle, whereas we're trying to manage them for the whole cycle. And related to that, the fear of missing out and the fear of having to participate in a rising market leads investors to take on inappropriate risks right at the top of the cycle. And then those risks are what causes capital destruction at the wrong point in the cycle.
And perhaps following on from that then, so what is your outlook for the rest of 2019?
We avoid giving specific forecasts for top-down market direction in particular. I think the conditions for market volatility to remain high are certainly there. Volatility means markets go up sharply as well as down sharply, and the turning points are very difficult to forecast. So our expectation is maybe a little longer time horizon, that markets are more volatile over the next 5 years than they were in the 2012 to 2017 type period.
Ben, thank you very much for joining us.
Thank you.
For more information on JOHCM Global Opportunities, please visit our website, FundCalibre.com, and don't forget to subscribe as well.